G'day everyone, and welcome to this explainer. Today, we're unpacking a massive topic you've probably heard your mates talking about lately, managing your own super. I'm joined by an SMSF specialist from Wendy Super Accounting to help break it all down.
Hello, thrilled to be here. We hear about this literally every single day. People get so excited about self-managed super, but they completely forget to read the fine print.
Exactly, which is exactly why today is all about education before emotion. So let's jump right in.
To really understand how this works, let's picture an everyday Aussie couple. We'll call them Andrew and Rachel. They're incredibly hardworking, and just last weekend, at a classic backyard barbie with some mates, they heard a rumor that completely blew their minds. Someone casually mentioned, "Hey, did you know you can use your superannuation to buy a house?" Well, as you can imagine, their ears instantly pricked up. The idea of taking control of their retirement savings and turning it into bricks and mortar? It sounds spectacular, right? It's literally the ultimate Australian dream. But right before they started endlessly scrolling through property listings online, they realized something absolutely crucial. They actually need to understand the rules of the game first.
Okay, let's dive into this, because that kind of marketing hook gets people like Andrew and Rachel so fired up. And look, it's not a lie. It is possible, and the excitement is completely valid. However, we really need to ground this Australian dream in reality right now. Doing this is not some magic shortcut to getting a new family home today. The reality is that to pull this off, you have to enter into a highly regulated, very serious legal structure known as a self-managed superannuation fund, or SMSF. And before anyone gets carried away by the excitement of that weekend Barbie, we absolutely have to hit the brakes and focus on getting educated.
All right, so we hear this acronym thrown around everywhere. SMSF this, SMSF that. What exactly is it in plain English? Great question. Let's break down the jargon here. An SMSF is simply a private superannuation fund that you manage yourself. Under the current legislation, an SMSF can have a maximum of 6 members. Usually, this ends up being just a small family unit, like Andrew, Rachel, and maybe their adult kids down the track. But here is the absolute most important part you need to grasp. All members must legally act as the trustees of the fund. Or, if they use a corporate structure, they all have to be directors of that company. You aren't just a member anymore. You are legally in charge. Wait, hold on a sec. So, with their traditional super fund, Andrew and Rachel basically just check an app on their phones to see their balance, right? A giant corporation takes care of the investments, the boring paperwork, and making sure no Australian laws are being broken. But you're saying that by moving to an SMSF, Andrew and Rachel are suddenly the bosses of the entire operation?
You hit the nail on the head. They transition from being passive members just sitting back and waiting for retirement to being the legal administrators of the fund. They take on all the paperwork, the investment strategy, the whole shebang, plus all the legal liability. There is no giant corporation managing the compliance behind the scenes anymore. It's entirely on them.
So the really crucial point here is this trade-off. Yes, you get incredible flexibility. You can decide exactly which assets the SMSF will hold and when to buy or sell them, like choosing a specific investment property, for example. That control is exactly what Andrew was so excited about. But that control comes with a very heavy price tag: ultimate legal responsibility. You are bound by the exact same Superannuation Industry Supervision Act, the SIS Act, as the massive industry funds. You are ultimately responsible for making sure your fund meets all its statutory obligations. Wow, that sounds like a lot of pressure. If something goes wrong, they can't just call a 1-800 customer service hotline to complain? Exactly. No hotline. The compliance burden falls 100% on your shoulders.
Let's move to the next concept and see how this builds, because this is where people so often trip up. I want you to think of an SMSF as a massive locked bank vault. The SIS Act strictly requires that all of the fund's assets must be maintained and clearly identifiable from the member's personal assets.
But wait, isn't it Andrew and Rachel's money anyway? It's for their retirement?
And that is exactly the trap. Once the money is inside that SMSF vault, it is completely separate from their personal wealth. It belongs to the trusts. You can never, ever treat your SMSF like a personal piggy bank. Mixing personal, business, and SMSF money is a massive red flag for the government, and it will land you in serious legal trouble.
Okay, let's put this into a real-world scenario. Say Andrew has his own small business, and things are just a bit tight this month. He just needs to cover a short-term cash flow gap to pay his staff on time. Can you just, borrow a little bit of money from the SMSF vault just for a week and put it right back?
Absolutely not. Not even a single dollar.
The rules strictly prohibit providing financial assistance to members or their relatives. Doing so is a direct breach of the superannuation laws. It really doesn't matter if you plan to pay it back tomorrow. The second you use that fund for a personal or business cash flow issue, you are breaking the law and risking massive penalties.
And this brilliantly illustrates the absolute cornerstone of Australian super rules, the sole purpose test. Under Section 62 of the SIS Act, trustees must ensure the fund is maintained solely for one core purpose, which is providing benefits for members upon their retirement.
Okay, that sounds like a lot of lawyer speak. What does that actually mean for our everyday couple?
Translated into plain English, it means your SMSF exists to fund your future retirement. Period. It does not exist to give you immediate lifestyle perks today, it doesn't exist to bail out your struggling business, and it definitely doesn't exist to buy you a cheap holiday house for the summer. Every single decision and investment must be objectively focused on growing that retirement wealth. All right, that brings us to the million-dollar question, the very reason Andrew and Rachel got so hyped up at the Barbie in the first place. Let's say they set up the SMSF, they do all the paperwork perfectly, and they use the fund to buy a beautiful suburban house. Can they pack their bags and move in? Or if they can't live there themselves, what if they rent it out to Rachel's cousin who just moved to the city? I am going to forcefully shut this down right now. The answer is a definitive, absolute no. You cannot live in that property. Your family cannot live in that property. You cannot rent a residential property to any related party.
Really? Not even if Rachel's cousin pays fair market rent?
Not even then. Under the sole purpose test and related party rules, residential property must be rented to completely independent third parties on strict commercial, arm's-length terms. If you or your family get a personal benefit from that property today, even if it's just using it for a single weekend getaway, you have officially breached the sole purpose test. Now, what you really need to understand is who is actually watching you. Massive industry funds are regulated by an entity called APRA, but SMSFs, they are directly regulated by the formidable Australian Taxation Office, the ATO.
The tax office? Okay, that sounds pretty intimidating.
It is, and you absolutely need to respect that. The ATO's primary function in this space is to ensure trustees act strictly in accordance with their obligations. They aren't there to just give you a slap on the wrist if you accidentally break a rule, like the sole purpose test. They actively monitor, and they heavily enforce compliance.
And if you don't comply, the penalties are, well, they're brutal. The ATO can impose massive personal monetary fines.
Wait, personal fines? You mean they can't just pay the fine out of the SMSF's bank account?
Exactly right. You have to pay those fines out of your own personal pocket. On top of that, you can be permanently disqualified from ever being a trustee again. And honestly, worst of all, the ATO can declare your fund non-complying. If that happens, the assets in your fund lose their tax concessions and get taxed at a devastating 45%. You could essentially lose nearly half of your entire life savings just because you didn't follow the rules.
So as you can see, managing an SMSF is a constant, rigorous reality. It is definitely not a set and forget thing. You must formulate and constantly review a documented investment strategy. You must maintain that strict separation of all assets at all times. And here's the real kicker, you must have a mandatory independent annual audit.
Wait, every single year?
Every single year. Before you can even lodge your SMSF tax return, an independent ASIC-registered auditor must legally scrutinize your financials to ensure you've complied with all the super laws. And if they find a breach, they are legally required to report you straight to the ATO.
Wow, okay. So coming back to our Aussie couple, Andrew and Rachel, the rumor they heard at the Barbie wasn't exactly a lie. You can buy a property with your super. But man, it was missing a mountain of vital legal context. Wisely, they decided to pause, step away from the shiny property brochures, and educate themselves on the fine print first. They realized that taking on an SMSF requires wearing the trustee hat and doing things completely by the book.
That is exactly right. And that is exactly why our philosophy at Wendy Super Accounting is always education before emotion. Look, an SMSF can be an incredibly powerful tool for building wealth, but only if you are fully prepared for the massive responsibilities that come with it. We specialize in SMSFs, accounting, and compliance, and we're here to guide our community ethically, to empower you with real knowledge, and to help protect the wealth you've worked so incredibly hard to build. So the provocative question you really have to ask yourself is, are you truly ready to take the wheel of your future and manage the compliance, or is it better for your peace of mind to let an expert drive?
Knowledge really is power, especially when it comes to the ATO and your life savings. But before we wrap up this explainer, we do need to be very clear about something.
Absolutely. This content is general and educational in nature and does not constitute financial advice.
We are not recommending you open an SMSF. We aren't recommending you buy property, and we certainly aren't promising any tax benefits. If you already have an SMSF or would like to better understand your compliance responsibilities, speak with our team at Wendy Super Accounting. Thanks for learning with us today.